Uncle Sam wants you to use CBDCs. The US Treasury is like that friend who always wants to control the music. They're pushing for CBDCs, which are like digital dollars but controlled by the government. They released a big report about it. It's pretty clear they're not fans of stablecoins, which are like digital dollars but run by companies. The government likes to be in charge, especially when it comes to money. CBDCs give them that control. They can track every transaction. They can even freeze your funds if they want. CBDCs are like the digital version of the dollar bills in your wallet, except instead of being printed by the Federal Reserve, they're created and managed digitally. Think of it like this: your money, but with a government tracker app. Stablecoins are kind of similar. They're also digital, and they're supposed to be pegged to the value of the dollar. But they're run by companies, not the government. And that makes the US Treasury nervous. One of the big reasons the government likes CBDCs is that they could make it easier to implement monetary policy. This is just a fancy way of saying they can control the economy by making it easier to adjust interest rates or even give people money directly. Imagine if during a recession the government could just deposit money directly into your digital wallet. No more waiting for checks in the mail. Of course, there are also some potential downsides. Section 4. Stablecoins. Risky business or just risky. The government is worried about stablecoins for a few reasons. They're worried about people losing money if the companies behind them go belly up. They're also worried about stablecoins being used for illegal stuff. Basically, the government sees stablecoins as a potential threat to their control over the financial system, and they're not wrong to be cautious. But some argue that the potential benefits of stablecoins, like faster and cheaper transactions, outweigh the risks. Section 5. Gold, crypto, and the future of money. So, what does this all mean for the future of money? It's still early days, but it's clear that we're moving towards a more digital world. CBDCs and stablecoins are just the beginning. Gold-backed stablecoins, which are supposed to be backed by actual gold, are also becoming a thing, but even they're not immune to government regulation. The US Treasury Department's recent report advocates for replacing privately issued stablecoins with central bank digital currencies, CBDCs, to mitigate potential financial risks. The report highlights concerns that the growth of stablecoins, such as Tether's USDT, could lead to increased demand for short-term US Treasury securities, potentially destabilizing the market if a major stablecoin were to collapse. Decrypt gold-backed stablecoins, which are digital assets pegged to the value of physical gold, are also subject to scrutiny. While they offer a hedge against inflation and currency volatility, they share similar vulnerabilities with fiat-backed stablecoins, including reliance on the stability of the backing asset and the integrity of the issuing entity. The Treasury's emphasis on transitioning to CBDCs suggests a preference for government-backed digital currencies over private alternatives, regardless of the underlying asset. This stance indicates a broader regulatory intent to centralize digital currency issuance, aiming to enhance oversight and reduce systemic risks associated with privately issued stablecoins, including those backed by commodities like gold. This push towards central bank digital currencies, CBDCs, over stablecoins is crucial for several reasons. 1. Centralized control and stability. CBDCs give central banks direct control over digital currency, unlike stablecoins, which are typically issued by private entities. By promoting CBDCs, the government aims to control potential risks in the financial system, particularly those that could arise from stablecoins managed by entities that may lack transparency or full regulatory oversight. 2. Monetary policy and economic stability. CBDCs allow governments to implement and manage monetary policies more effectively. With CBDCs, central banks could directly control interest rates on digital holdings, manage liquidity, and have greater control during economic crises, unlike stablecoins, which could create complications if they become widely used for payments outside central banks' control. 3. Financial inclusion and innovation. CBDCs open new avenues for financial inclusion, as they could be accessible to anyone with a digital wallet, offering banking services to the unbanked. They also promote safer innovations in digital finance while ensuring that regulatory standards are upheld minimizing risks associated with private stablecoin projects. 4. Systemic risk and financial security. Stablecoins, especially those not backed by tangible assets like the US dollar or gold, may face issues with solvency and transparency, potentially destabilizing the financial system if a major issuer collapses. A CBDC overseen by a central bank reduces these risks, enhancing overall financial security. 5. Challenges to privately issued stablecoins. The call for CBDCs also challenges the role of gold-backed stablecoins. Although these provide an inflation hedge and store of value, they still involve risks tied to the issuing entities. CBDCs would establish a regulated, government-backed alternative, signaling that governments may prefer digital currency systems they can monitor, control, and audit over privately held assets. The Treasury's stance on CBDCs signals a significant shift in how governments view the future of digital finance. It shows a clear preference for a regulated, centralized digital currency framework, potentially marginalizing private digital currencies like stablecoins and impacting the cryptocurrency industry overall. ChatGPT said, ChatGPT, the U.S. Treasury Department's recent report sheds light on a significant shift in regulatory priorities within the digital finance sector, underscoring the government's push for central bank digital currencies, CBDCs, over privately issued stablecoins like Tether's USDT and gold-backed stablecoins. This pivot reflects a strategic move to strengthen oversight, centralize digital currency issuance, and reduce risks that privately managed stablecoins could introduce into the broader financial system. The report identifies the following key reasons for this preference: centralized control and stability. Unlike stablecoins, which are managed by private entities, CBDCs would be directly issued and controlled by central banks. This direct oversight minimizes risks associated with transparency and regulatory compliance, especially given the rapid growth of stablecoins in an underregulated environment. Central control of a digital currency can safeguard against potential destabilizing events, such as a significant stablecoin collapse. Enhanced monetary policy and economic stability. CBDCs would empower central banks to manage monetary policy more effectively. For instance, central banks could adjust interest rates on CBDC holdings, directly influence liquidity, and maintain control during economic downturns. In contrast, stablecoins, used increasingly for payments and investments, could complicate monetary policy if they gain widespread usage outside central bank oversight. Promoting financial inclusion and digital innovation. With CBDCs, the government sees a potential pathway to expand financial inclusion, as they could be accessed by anyone with a digital wallet, offering banking capabilities to underserved populations. Additionally, CBDCs could spur safer innovation in the digital financial space, encouraging advancements while adhering to regulatory standards. Systemic risk mitigation. Privately issued stablecoins, particularly those not fully backed by stable assets, may pose risks to financial stability, particularly if they lack solvency or transparent backing. A stable CBDC overseen by the central bank could help mitigate these systemic risks, ensuring a secure digital currency infrastructure. Impact on gold-backed and other commodity-linked stablecoins. Even gold-backed stablecoins, while offering an inflation hedge, face scrutiny due to risks tied to their issuing entities' stability and transparency. The Treasury's preference for CBDCs hints at a future where government-backed digital assets may be favored over private commodity-linked currencies, providing a regulated alternative that government entities can monitor and audit. This regulatory stance indicates a broader move towards centralized, government-regulated digital currencies, aimed at preemptively addressing risks that privately issued stablecoins might pose to economic stability. As CBDCs gain traction, the influence of private stablecoins could be marginalized, potentially reshaping the cryptocurrency and digital finance landscape in a way that aligns more closely with traditional financial regulations. The bottom line is this: the world of money is changing, and it's going to be interesting to see how it all shakes out. Don't miss the bus and subscribe.